Well, accounting concepts we apply while doing FS, financial statements, and when doing accounting we take all these into account. So let's get going one by one with illustration and explanation. Business entity concept. Your business is separate from its owners. This is the business entity or separate entity concept. The owner is separate from the business. The owner putting money into the business, that's capital. Owner taking money from the business, that's drawings. Yeah. And limited liability companies are absolutely a separate entity. They can sue another business or they can sued by other businesses. Money measurement. Any transaction needs to be measured in terms of money, otherwise that will not be a transaction. For example, it's raining outside. This is not a transaction, this is an event. But let's assume you fixed your roof because of rain and you had to pay some money. That is a transaction. So money measurement. Materiality. Now material means important or significant. So in organization, so many transactions could be material, could be immaterial. If it is, let's assume like a big company, the financial statement shows 1 million to 200 pounds. So this 200 is immaterial for him. He's gonna round it up down to 1 million. But if a small business 2,200 pounds, this 200 is material for him. So that is called materiality. So some small expenses could be immaterial, but it depends on the size and nature of the business. Immaterial items we don't record in the business, and the material items we must record in the business. Cost is also known as historical cost concept. Historical, we have done the balance sheet and financial position. We write the cost and all the year 1, year 2, year 3. Cost remains as it is, like 2,000 is the value of the car. It remains 2,000 over the years. So that is your cost concept. It is historical cost. Yeah. Then you do the net book value or accumulated depreciation. Going concern, a very important one. You assume the business will continue in the foreseeable future. This is the main concept here, and you get marks by writing this. But what is the ultimate idea here? Going concern means your business will not shut down within next 6 months, 12 months, even 2 years. It will keep going. So why it is? Your suppliers, your customers can trust you. You will not vanish from the economy or the market. That is your going concern. How do you know the going concern problem going on in an organization? This is a popular question. Problem. Yeah, going concern problem. So if you see a business is selling its non-current asset, like sell a land, big land sold, yeah, by the company, or selling its shares, or taking too much loan, so they're in financial difficulty, so they might get vanished from the market, removed. Yeah. Accruals or matching concept, which you have learned heavily in chapter number 12, accruals of expenses, and it's going to come later on accruals of income or prepayments of income. Accrual says unless you earned, you don't record it. Yeah, unless you earned the money or the money is supposed to be paid. I'm going a little extra here regarding accruals concept. Accruals means income should be matched with the expenses. That's the book definition. But my definition, if you meant to pay 12 months rent, you will have to recognize it as an expense. Or if it is income. Whether you paid 10 months or 16 months, that's not a matter. The matter is you need to recognize how many months? 12 months. That's your accruals concept. So thus the prepayment and accrued comes up here. If you paid in advance, that's prepayment. If you did not pay anything in this particular period, that's accrued. Consistency. There are so many accounting rules we follow, like for depreciation we follow straight line or reducing balance, yeah, diminishing balance. Or for inventory we follow FIFO, AVCO. So if you've been following one concept, you'll be carry on doing that on this. You just can't from straight line to reducing balance all on a sudden unless there is a good reason. This is called consistency. So this is inventory valuation or any other accounting rules you're following. You got to be consistent over the year. Yes, you can have a good reason. For example, your assets been non-current assets like a building or furniture or heavily there, so you've been using straight line. Now you have more machineries. Yeah, machineries use heavy in the first few years and less in the later years. So then you can change it to the reducing balance method. Well, the next one, there are quite a few examples like inventory, doubtful debt. These are relevant examples of your consistency and accruals. The prudence, taking a conservative view or pessimistic view towards your FS. Yeah, lowering the assets, lowering the profit, not to show your assets higher, not to show your profits higher. Yeah, like for example, inventory. Later in this chapter, we're going to do inventory valuation. Inventory should be taken lower cost and net realizable value. So being prudent is good. And finally, there are little more. Realization. Your sales should be realized when it has departed from your premises to your customer's premises. The ownership has been transferred. Yeah, a legal title has been transferred from buyer to the seller. Then you can realize the sales. Realize means you can write in the income statement as the sales, like sales has occurred. If it is not, you can't realize the sales. Duality, which is double entry, which you already learned it. Debit, credit. Every transaction has got two effects. Duality. Now, we have a little bit here. I'd like to go over this policies. Like, a business selects its accounting policies to fit in with objectives of. We have few objectives. These are objectives of the financial statements accounting. All the concepts and accounting you're doing, it should be relevant. Yeah, like useful to the users, reliable, you can trust it, dependent upon the users. Comparability, from last year with this year you can compare, or your company, other company, you can compare and take a decision. Understandability, which means less jargon. Less jargon. What do you mean by jargon? Like you don't use heavy accounting words like trial balance, balance sheet. These are typical accounting words, maybe not understood by non-accounting people. So for example, your boss may be a non-accounting person. He would love to have easy jargons. Yeah, well, that's all in this video. Let's check out the next video on inventory valuation.